All right, as a self-employed person or as anyone in business, as we'll see then in corporations and partnerships later on, you acquire business assets and you use those assets in your trade or business, and when you have them, if they're tangible, personal property, if they're real property, you take those assets and you depreciate them. If they're intangible assets, goodwill, those types of costs, patents, royalties, you capitalize them and you amortize them. We're going to talk about the rules for those right now. There have been, surprisingly few questions in this area, but it's an integral part of almost everything that we do. So I have to cover a lot of things and just show you a few questions, but they're still worth doing. I want to first talk about the term that we use in general, and that's referred to as cost recovery. Cost recovery is another word for basically depreciation. I'm going to be using those two words interchangeably as we go through. The IRS publications use depreciation and they use cost recovery. But what we look at is trying to recover the cost of purchasing an asset. There are four things that you need to know to determine how to depreciate an asset or cost recover the asset. The first thing you need to know is the basis. In Chapter 6, we talk more about how do you determine basis, but for now, we can just assume that somebody goes out and acquires an asset and pays $10,000 for it. That would be cost. That's another word for basis. Okay? As things improve it, as you spend money to improve it, as you go through and depreciate it, you have things that adjust the basis, but basis of property is one thing you need in order to calculate your depreciation or cost recovery. Second thing you need to know is what's referred to as a recovery period. Your recovery period is based upon the type of assets that you have. If you buy tangible personal property, while there are other things that exist besides what I'm going to tell you, they tend to fall into two camps, and that is a recovery period of 5-year or 7-year property. So oftentimes when you talk about, I bought some assets, it's a 5-year asset, it's a 7-year asset, it means that that's how many years we're going to recover the asset over. If it's real property, it's going to be 27.5 or 39 years. Those are the years. Okay? And what happens is that once you've identified what that group is in terms of their recovery period, what their class is, then everybody uses the same rate. So in my first year, if I buy a 5-year asset, I'm using 20%. My second year, I'm using 32%. Everybody is, so that we're using standardized amounts for those. We don't use any type of residual or salvage value. We recover the cost, so it's real easy to go through. Third thing you need to know is the method. What method are you using to depreciate the asset? For the purposes of tangible personal property, while we're using what's called MACRS, which is the Modified Accelerated Cost Recovery System, the method that we're using for tangible personal property is a double declining balance method. The method that we're using for real property, while it's still under the umbrella of MACRS, Modified Accelerated Cost Recovery System, this Modified Accelerated Cost Recovery System for real property is straight line. I don't understand why they call it MACRS when it's straight line, but I didn't write these rules. But that's the method. What method of depreciation are you using? And then third, what is your convention? Conventions are broken up into 3 broad conventions. First convention is what's called a mid-year convention. Under tangible personal property, the law assumes that you're buying your property evenly during the year. So you're buying equipment in January and March and June and September and December. And you're buying it, and rather than saying, I want to depreciate this asset for 11 months, and this one for 9 months, and this one for 4 months, and this one for 2, we just assume that everything's bought mid-year, halfway through the year. That's a mid-year convention, okay? Now, if you don't buy things evenly through the year, but you buy more than 40% of your assets in the last quarter of the year, that's called a mid-quarter convention. And you have to say, what assets did I buy in the first quarter, what in the second, what in the third, what in the fourth, and you depreciate them based upon how many quarters they've been in service for that year. It is a royal pain in the neck to go through that. If you're dealing with real property, you also have mid-month conventions. You don't have that for tangible, and that basically says if you buy it any time in the month of January, assume that you bought it on January 15th. Buy it sometime in March, assume it was March 15th. The year of disposition, you sold in October, assume it's October 15th. I don't want to know the number of days. All of the tables are built on this convention. When we look at MACRS, just to sort of put these up now that I've described them to you, is under MACRS, when we have tangible property, it's 5 or 7 years. The MACRS rate is double the straight line rate. So if you have a 5-year asset, the straight line rate is 20%, double that is 40%. Okay, so and it's also what's referred to as a declining balance method. It declines each and every year. There's a half-year convention in place that says, that I've mentioned before, you buy it halfway through the year. And that's how your tables are basically built. We'll talk about that in a problem in a minute. The mid-year convention exists unless you have a mid-quarter convention, which said you're buying more than 40% of the assets placed in service in the last quarter of the year. When it comes to real property, you have two different groups of real property. One's classified as residential property. Residential property is depreciated over a 27.5-year period. You have commercial property, which is sometimes referred to as non-residential property, commercial. That's depreciated over a 39-year life. They use a straight line rate, and they use what's referred to as a mid-month convention. So you've heard that twice. We'll see it within a question, and there are sometimes computations that you as a candidate have to go through. Now, in addition to that, we have what's referred to as listed property. Listed property is the fun stuff. Listed property are things that you can use personally, and as a result of using them personally, the service has you separately report them. Up until September of this year, your listed property included computers, cell phones, photographic equipment, video equipment, vehicles of less than 6,000 pounds, and 6,000 is a lot of weight, okay? SUVs don't fall into this category, but just about everything else does. And it's there because we're looking at assets that are not used only at their business. This year, cell phones fell off the listed property list. And that's because cell phones were like $49, and then you had to separately disclose them, and you throw cell phones away. I mean, so that dropped off the list. And what that meant is that these different types of items are separately disclosed. You have to include what's the personal use versus the business use. I've had audits where the IRS wants to know the stuff on the listed property, and what they do is if you don't account for it by saying that there's some element of personal use, they basically assess an income against the shareholders. It's ridiculous. But for listed property, just to give you an idea for vehicles, what it means is that you also are limited in the amount of your deduction. In the text to talk about it a little bit more, but for example, if you're buying a vehicle, your first year's depreciation cannot exceed $3,060. You buy yourself a very inexpensive car for $20,000, your depreciation is $3,060. You buy a very expensive $100,000 car, your first year's depreciation is $3,060, and that's assuming you use it 100% for business purposes. If you use it for less business purposes, say 80%, you take the 3060 times 80%, that's your deduction. But every year they seem to change that indexing, by indexing the amount of the allowed deduction. Your second year is capped, your third year is capped, your fourth year is capped. So you get all those different things, if you will, in the depreciation area. You will see some depreciation here, you'll see some depreciation in the property area as well, and you'll see some in the corporations area when they dispose of property. But for now, let's take a look at two questions, questions number 22 and 23. Under the Modified Accelerated Cost Recovery System, MACRS, and it's always good to get the words in case you haven't remember those, for assets placed in service after 1986, which statement is false? So that means we got three true statements. One thing I like to do, when I have a statement, usually we're like it's which one is true, so you get three bad statements, and you're reading the bad statements, and then later on you're trying to say, was that a good statement or a bad statement? This one's good because there's one bad one, and then there are three ones that you go, yeah, that's right. So let's see, used tangible depreciable property is excluded from the computation. Let's see, I don't think he said anything about used versus new, so probably not that one. I'm just not really sure. That may not be true. Salvage value is ignored for purposes of computing MACRS. Absolutely, it's not considered. You basically recover the cost. There's no salvage. So that's a true statement. Straight line depreciation is allowable. It is. The buildings, the straight line depreciation, absolutely. The recovery period for depreciable real property must be 27.5 years. For depreciable real property, it must be at least 27.5 years. Yes, because it's 27.5 and 39. So the false statement is A, that used property must be excluded, and it's like, no, it doesn't matter whether it's new or used. Question 23 really threw me when I saw it for the first time. August 1st, Graham purchased and placed in service an office building costing $264,000, including land of $30,000. What was the MACRS depreciation for the year? Excuse me? Where are my tables? How do I figure this out? And you basically had to go through it and say, all right, it's an office building, so it's not residential, so it's commercial. Commercial's 39 years. The land is in there. You can't depreciate land. I have to take care of that. And it's on August 1st, and August is the 8th month of the year. So let's see if I can figure this out. And what the candidate had to do was this. You start with the cost of the land of $264. I'm sorry, cost of building and land of $264. Subtract out the land cost, and therefore you're then going to depreciate the $234,000 that's remaining. For commercial property, how many years do you have? 39. Now if you divide the 39 into the 234, you come up with a very easy annual cost recovery of $6,000. Now, how many months are you depreciating it for? If I bought it in August, I'm going to depreciate it for half of August, all of September, October, November, and December. That's 4.5 months. So basically 4.5 months over 12, you can do it there to make sense, 4.5 over 12 times the 6,000 is $2,250. So the candidate without tables had to go through and do those computations, okay? Pretty extensive. Let's try another one. Let's go to question 25. How is the depreciation deduction for non-residential real property placed in service determined under regular purposes for MACRS? And the answer is D, straight line over 39 years. Okay, so those are some of the things. 27.5, 39, straight line, 5-year, 7-year property. The tables for those other ones, we don't have any real computations here for them, are in the textbook with some little illustrations on how you do that. So please take a look at that if you haven't had a chance to do it.